Good afternoon, everyone. It's great to be back with you. It's been a bit of a hiatus, off for a few weeks, both rejigging our studio and took a little time. It's been an interesting and a beautiful summer, and certainly where I am, and I think where a lot of folks are. Wanted to do a recap today, kind of have a look at what has been going on in the realm of investing and do it through the eyes of that question I've been getting constantly since mid-February, which is, what should I do? Should I be going to cash? Should I be putting more money in, et cetera, et cetera? We're going to talk about that. And we're glad to be with you. As always, you can find us on Facebook at Macbeth Group. You can also find us on Twitter and on Instagram. At Twitter, we're Cash Coach Canada. Instagram, we are at Macbeth Group. Want to thank our sponsor, the Simple Plan Life Insurance. You can get your free life insurance quotes at getthesimpleplan.com/quotes. You can also figure out how much life insurance coverage you need at getthesimpleplan.com/how much. As always, we're always offering a helpful tool of some kind. We have our Simple Plan Retirement Calculator. You can go and figure out how much money you're going to need to retire in the way that you want to. You can get that at bit.ly/SP-Retire-Calc. That's bit.ly/SP-Retire-Calc, and that is all lowercase. So, it's been a pretty crazy year, and from an investment point of view, honestly, things seem to be quite defying gravity in some ways of thinking about it. We have it can only be called bleak economic indicators, unemployment, gross domestic product, job losses, business losses, bankruptcies, the list goes on. And yet, somehow it seems like investment markets have baked that in or aren't getting the message or something to that effect. So, of course, we had a big downturn back in February. We're going to take a little look at what all that looked like. And as always, when these things happen, people ask the question, what should I do? Should I take action? We usually want to be reactive when things go snaky and we want to do something. It's a natural point of view, but maybe not the best idea. So we're going to take a look at, let's have a look here. We're going to get to that graphic. Let's have a look at what's been going on the S&P 500, among other things. So this is the S&P 500 index. We've got it set here for, I think it's a year. Yes, it is a year. Okay, so, thinking of that question, what should I do? Well, we're going to get to the answer, and it's the same answer we've always given. So what should I do? Well, let's look at what has happened here. Now, here on the left on the table, we've got a few interesting numbers. The year-to-date high is, it's today, 3,576.89. So this is the S&P 500 index. That's just the broad index of 500. It's a little more than 500 actually, but around 500 U.S. companies that trade on the stock exchange. And that index hit a high today. It hit a low back on March 23rd of 2,191.86. Whoops. And that was a very significant drop. I think we were down about 32% in that range there at the 23rd of March. And that drop happened over the course of about 6 weeks, because our previous high until this month, August 2020, our previous high was mid-February. And so in the course of about 5 weeks, we had a pretty big plummet. Let's have a look. We can see the chart here. So again, those are year to date. That's calendar year. That's what's happened in 2020. Now we have a chart here that shows the same thing. This is the S&P 500. Over on the left, you'll see we're at September 2nd, 2019. And over on the right, we're all the way over to today, which again is September 2nd, 2020. So that's 1 year's participation in this whole excitement. And we can see where the excitement really was. So here we have our peak, our prior peak, that was in the week of the 10th of February. And that took a pretty big plummet down to the end of the week, March 16th, which was pretty exciting stuff. So you can see in the top left corner up here, it displays the information for the particular days. So we'll see here that on February 10th, the close was 33.80. And on March 16th, it was 23.04. So let's see what that is exactly. 23.04 divided by, what did I say that was? 33.08? 33.80. 33.80. 68. So we were down 32%. Very interesting stuff. And yet, here's where we can see what's happened now over the last 12 months. We started over here. It's not giving us our pretty little box of numbers there. Why is that? Okay, so we were over here somewhere in the 20. Oh, it goes over to the right. Okay, so up in the top right corner there now. September 9th, 2019, we were at 29.78. And now we're all the way up, pushing close to 3,600. Today closing at, or actually end of last week, 35.83. So things are just generally quite weird. It's been a strange year. We understand why the big plummet, but it seems almost to defy logic that we would be now up. We're up, all-time high. So that's the S&P 500. That is what's gone on in the U.S. market. So interesting stuff. So think of that. The question people were asking, maybe right around here in the first couple of weeks, because you have to remember it wasn't really until early March that we started to recognize just how serious this was all going to be. Things started locking down. And so, we have this big plummet, and people were asking the question, well, what should I do? And that is a market timing question. That question is about should I go to cash so that I aren't subjected to these losses? Should I invest more money so that I'm buying low because it's going to go back up, or what have you? And that's what that question is about. So we see what's happened in the U.S. So now, even though we have really, the U.S., if you watch the news, pick your flavor of news, decide which part of it you think is true. But there have been 180,000 deaths in the United States from COVID. At least that's what they tell us. And there are many, many people sick, and it's spreading. And, is it going to hit a peak? Has it already peaked? We don't know. School's back in. All sorts of stuff is going on. So lots of turmoil and turbulence. And yet the stock market carries on. Let's have a look at what's gone on in Canada. I'm just using the Globe and Mail's charts here. So here in Canada, things have not been quite as rosy, though in some ways they've been better because, the bottom at 11,172 in March 23rd, we're now up at 17,970. So let's see how much of a jump that is. That's a 39% jump from the bottom to today. But if we go to our annual chart here, so we go to the 12-month view, again, we see our big plummet here, same date, February 17th in Canada. We had a bit of a week's plateau there. And then, similar bottom is March 16th. We bottomed out earlier, got there a little faster. But we're not up from where we were. We're still down. So let's call it, let's see, we're down 16,709. All right, so that means we're still off by 6 or 7% for the year here in Canada. Maybe a little less because we've got this week to go. Yeah, it's been a pretty good week. So we're still down a bit, but we're down. We're down from where we were at the beginning of January. We're slightly up from a year ago. Pretty close. I think end of last week we were down 2%. We were off 2% for the prior 12 months. So, all right, that's a lot of numbers, but let's recap. The U.S. is up overall, both for the year, and the U.S. is back up above the high that it achieved in early February. Canada down a little for the year, for the 12-month period, and still off about 6-7% from the peak in February. So overall, both of those numbers fall into what you would call the normal range of behavior, except, of course, it's been anything but normal. So when we ask the question, well, should I be timing the market, because that's really what that question is, the answer is always unquestionably no. And that's because we don't know what's going to happen, and we really can't. There are a few people out there that have ways of working on the market timing of things in short periods of time that they do. They maybe make some great gains, but for the most part, the money that you're going to realize, the gain you're going to realize, is going to come over long periods of time, and we can count on that growth over long periods of time. What we cannot count on is any certainty over short periods of time. So if you ask yourself, let's go back and look at that S&P 500. So we're at an all-time high over here. As of today, we're at an all-time high. Even with business turmoil, all manner of political and social turmoil in the United States. It's an election year, probably the most volatile one in my memory. And who knows what's going to happen. On top of that, a lot of businesses are suffering. There's been bankruptcies, unemployment, and et cetera, et cetera, et cetera. So maybe the market's maybe it's all costed in. That's the phrase that gets used. It's all already factored into the market, all these problems. I tend to think not, but I tend to believe in the long-term growth of the market and in the short-term uncertainty of the market. And so that's what we can invest in. And so let's have a look. Let's imagine that we had tried to do some market timing. This is just a thought exercise. It's not a perfect analysis. It's just, kind of a little peek at what you could experience if you tried some market timing. So this is as of the 5th of August, 2020. And so if you were fully invested, and this is for the Canadian stock market, the S&P, the TSX, the S&P TSX, that is the Toronto Stock Exchange Composite Index. So if you had bought that as an index fund on January 1st, 2020, if you stayed fully invested through to the 5th of August, so you didn't touch anything, you just let it go, in spite of all the volatility, as of the 5th of August, you would have been down 2.2%. Now, and that's a total return, so it includes dividends. Now, if you had just missed the best single day of 2020, so let's say you did some crazy market timing, you sold everything for one day because you thought, well, the market's going down. And what you found was on that day, the market went shooting up. Well, if you missed the performance of that one best day of 2020, rather than being down 2.2%, you would be down 18.9%. If you missed just the best 3 days of 2020, you would have been down 36%. And if you missed the best 5 days of 2020, you'd have been down 44%. Now, you could probably argue well in the other direction as well. If you had missed the worst day of 2020, you'd probably be up. And if you'd missed the worst 3 days of 2020, you'd be up even more. And if you'd missed the worst 5 days of 2020, you'd be up more still. The problem is you have no way of knowing when those days are. We never know where the bottom is. We went through a huge downturn in 2008. This one was similar. It was just much more rapid. And peak to peak, to get from the pre-2008 peak back to that same peak after the crash in that period, 2007, 2008, that took, I think, about 6 years to get back to the peak. This one has taken 6 months. Why that is, A, nobody really knows. B, there may be some kind of post-game analysis that goes on when numbers come in over time where people say, well, historically we think this is what happened. But a lot of that is just storytelling. It's making up concepts around facts, trying to understand market behavior. But the truth is the market is comprised of millions of investors and also now, of course, comprised of millions of machines that are doing automatic trading and millions upon millions of algorithms of the ways that people are trying to manage their investment from, mom and pop Main Street all the way to the most sophisticated, large investment companies that you don't even understand how they work or how they exist. There are books about that kind of stuff, but there's some really interesting things going on out there that affect the market that have nothing to do with the quality of companies and the performance of their businesses. So all this to say, you can try to time things and you may get lucky, but you are much more likely to encounter disaster in doing so. And so you're just much better off to be, as we always say, systematically investing over long periods of time. If you were investing monthly, you'd have been buying when the market was going down, and then you were buying when the market was coming back up and prices were increasing. All the way through. You get the effect of what's called dollar cost averaging, and it all sorts out in the end. It's going to give you that market performance over a long period of time. If it's the S&P 500, you can expect somewhere in the 8.5 to 9.5% range, maybe a little better than that. If it's the TSX, probably not nearly quite as good as that, at least not for the last 20 plus years, but still you can do fine for yourself. Trying to figure out the angle to beat the market is a game that you will inevitably fail at, and so you want to avoid trying to do that. So we have the evidence there of what could have happened. Again, it's just a thought experiment. It just looks at, well, if you missed these few days, but it's sobering. You only had to miss the one best day. Take your money out, and you can see how that behavior might happen. Like, oh my gosh, the market's crashing. I'm selling. I'm moving to cash. And never mind the kinds of tax implications that might have had in doing that. But you take that action because the market is tanking badly, and it was pretty scary. It certainly was when it was going down. And then you see it start to come back, and it goes ramping up really quickly. Let's go back and have a look again at how that worked, because wasn't like there was a lot of time to consider this and think, well, maybe I'll take a look at something and I've got some ideas about what I might do. It's like, let's look at that. This is the S&P 500. Again, this is a period, even just from here, that's the 10th of February. So things are ticking along nicely. You're not thinking, oh, well, things might be going badly. Well, you're not panicking. 17th of February, not going, well, But then the drop to the 24th of February, okay, and then a little tick back up. So we're still not going to really panic terribly. And then we have this plummet that takes place from the 2nd of March to the 16th of March. That's 2 weeks. And now you're at the bottom. So yes, in those 2 weeks, you might go, oh my gosh, the sky is falling. What should I do? Well, except now you're at the bottom. You just don't know you're at the bottom. And so then you go, well, I'm going to sell. It's like, okay, boom, out you go. Well, if you sold at the bottom, let's say you picked where the bottom was, just through pure dumb luck, that was 2,300. It went up 20% that next week, 25%. 25%. You missed a 25% gain week, right? And then it came barreling back out, and now it's climbed out. Tell yourself the story where you can convince yourself that you're smart enough to pick one of these points where you know that we're at the bottom or we're at the top or it's about to turn down terribly or it's about to turn around and go up magnificently. You had no idea. None of us had any idea. This is the market at work. So that's just how it goes. So we cannot predict, we cannot know. And so trying to jump in when we don't know is a very, very dangerous game. So that's, again, today's lesson. Stay invested systematically. Keep putting your money in. We always advocate now doing it with low-cost robo-advisor index funds. That's what we do with clients because you can never know what's going to happen with any individual stock, but you can know that over time the market's going to go up. And by the way, a big reason this market is up so much right now from the bottom is because of tech stocks. It's Apple and Tesla, among others. So they are pulling that index up. So if you want it now, of course, if you had picked, you said, well, I'm only going to put my money in Apple and Tesla, you would certainly be doing even better. But then, now you're trying to pick winners and losers, which is a very dangerous game. If you want to have confidence in your investing without the worries, you buy the index, those big players are pulling the index up while others that are not performing as well are pulling it back down to some extent. But you're getting that net effect of the 8.5% to 9.5% return over long periods of time. So that's all we wanted to share with you today. Glad to be back in the saddle. A little off. We missed a day. It's Wednesday today, but we will be back with you on Friday. Want to thank our sponsors as always, the Simple Plan Life Insurance. Get thesimpleplan.com/quotes to get your free life insurance quotes. Check whether you're paying too much or too little. Insurance rates are going to start going up pretty quick here, I would bet. So you want to just at least be checking whether you're getting the best value you can. You can also check there at getthesimpleplan.com/how much, whether you have the right amount of life insurance. And it goes both ways. Often people are carrying too much insurance because they bought a big chunk when their family was young, and then they find they don't need all that coverage anymore and they could cut back on some of it. If you're wanting to work on your retirement planning, you can get a simple start at the Simple Plan Retirement Calculator. That's at bit.ly/SP-RetireCalc. bit.ly/SP-RetireCalc. That's all lowercase. I want to thank you for spending time with us today. My name's Brad Macbeth. You can find us on Facebook at Macbeth Group. And so we look forward to seeing you again on Friday. Until then, take care, and we'll be back with you then.